Imagine this, the stock market hits record highs while a war rages on. Confusing, right? On April 23, 2026, the S&P 500 closed at a staggering 7,137.90. That's the 8th record high of the year. Meanwhile, Iran attacks ships in the Strait of Hormuz, pushing oil prices above $100 a barrel. How can stock prices soar in the midst of chaos? This paradox invites us to explore investor psychology, the taco trade, corporate earnings, and the relationship between the stock market and oil prices. Understanding these elements explains why markets seem unfazed by war. First, let's dive into the taco trade. This acronym stands for Trump always chickens out. This trading strategy emerged from previous geopolitical shocks caused by the president. After fear-driven sell-offs, he's often reversed course, prompting massive market rallies. Investors learned not to panic and sell after these shocks but to hold or buy. The taco trade shapes expectations around events like the current war. Many investors believe the conflict will end soon, based on past patterns. They're not pricing the ongoing conflict but betting on its resolution. Positive headlines about potential peace talks feed this optimism. Next, let's compare the perspectives of the stock market and the oil market. The stock market creates a future-looking lens. It prices the possibility of corporate earnings returning to form after the conflict. If the war ends quickly, companies will maintain profitability. Thus, the S&P 500's recovery reflects that hopeful outlook. Conversely, the oil market focuses on current physical realities. Supply is disrupted, and recovery won't happen overnight. Oil production remains low, and restarting key facilities takes weeks. Even with peace talks, physical supply challenges may linger far longer than anticipated. Now, let's take a closer look at corporate earnings. Despite geopolitical turmoil, earnings reports have largely exceeded expectations. The biggest banks reported strong profits, reflecting healthy financial conditions. Even Boeing, amid its struggles, showed positive signs by narrowing its losses. Strong earnings lend tangible support to the market's optimistic outlook. As we wrap this up, let's consider the recent revival of tech stocks. After an early 2026 downturn, valuations have become appealing. Companies involved in AI are capturing attention again. Lower prices and ongoing expansion in AI spending draw investors back in. These factors make the tech sector increasingly compelling compared to more traditional stocks. However, don't overlook existing risks. Oil remains above pre-war levels. The Iranian conflict shows no definitive signs of resolution. As earnings season continues, various companies still face uncertainties. For instance, Southwest Airlines indicated ongoing challenges from high fuel prices. In conclusion, the stock market's record highs and soaring oil prices reflect differing insights. Investment strategies that focus on tech and defense companies remain favorable while maintaining caution. Whether the market holds optimism or comes back to reality hinges on future geopolitical developments and corporate performance. Investors must consider this balance. The stock market prices hope, while oil prices reflect physical realities. Ultimately, one message will prevail. Don't miss strategic opportunities. Adapt your portfolio to navigate this unique market dynamic effectively.